Welcome everyone, my name is Jason Weaver. I'm the managing partner with Weaver Consulting Group, a local registered investment advisor practice here in Huntington Beach, California. Thank you for joining us today in our video series 3 and 3. Today we're going to be talking about sector performance, growth versus value, and U.S. corporate debt. Sector performance. The stock market is often broken down into 11 major sectors representing the overall economy. Energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunications, utilities, and real estate. Sector performance. As you can see year to date, healthcare, technology, and consumer discretionary stocks are leading the market. That generally happens when you have a very strong economy or you have a GDP or gross domestic product reading over 3%. Well, in the second quarter of 2018, we had a 4.2% reading. That makes sense that those stocks are outperforming year to date. But as we start to look through the last 3 months, you're starting to see utilities and consumer staple stocks doing a lot better. That generally happens when we expect GDP numbers to start to slow. Potentially the stock market might be front-running that the fourth quarter of 2018 or the first quarter of 2019, we might just start to see some slower GDP readings. Growth versus value. A growth company is anticipated to grow at a rate significantly above the average. Typically they don't pay dividends and they reinvest back in them to themselves. Generally speaking, those are going to be technology and consumer discretionary stocks. Amazon and Netflix be good examples of that. A value stock. Value stocks typically trade below their fundamentals and pay high dividends. Generally speaking, again, they're going to be in the healthcare and financial services sectors. JP Morgan, Wells Fargo, Pfizer are good examples of value stocks. From one year to the next, growth or value may outperform. As you can see, in 2009, growth outperformed value by 10%. In 2015, growth outperformed value by 8.5%. But in 2016, when we had a little slower economy, value actually outperformed by 10%. But as the economy picked up into 2017 and 18, we're starting to see growth outperform values pretty significantly. And again, that's because we're getting those higher GDP numbers as the economy is doing very well. U.S. corporate debt. A corporate bond is a debt security issued by a corporation and sold to investors. Backing for the bond is usually the payment ability of a company. So we really have to watch the credit rating, and the credit agencies will give an investment grade rating or lower based upon the backing or the general payment ability of that company. Since about 2000, we've seen a real explosion of U.S. corporate debt, where you stand about $6.4 trillion of U.S. corporate debt. That's not an issue in a very good economy, but if we start to see the economy falter, that corporate debt could actually come back to bite us. 52% of U.S. investment grade bonds, that's BBB or higher, are one notch away from junk. That's also something we're watching very closely. Thank you again for joining us in our series 3 and 3.